Welcome back to the deep dive. I want to start today with a question, and I want you to be honest with yourself. When you look at your bank account or you check the news,
hmm
you see the price of groceries. Do you feel like the ground is, I don't know, shifting? Because I was looking at the economic data this morning, and I just had this nagging sense of unease. It feels like the rules of money that we all grew up with, save your cash, pay off your debt, trust the system, they just aren't working the way they used to.
It's a very common feeling right now. I hear it all the time. We're seeing signals that are, well, they're frankly pretty contradictory depending on where you look. You've got the stock market doing one thing, the real economy doing another, and people are just caught in the middle trying to figure out if they're going crazy or if the system is actually breaking.
Right. And that's exactly why we need to dig into today's source material. We are unpacking a conversation from ITM Trading called the Gold Rush Hour.
Yeah.
And I have to say, the format of this one really grabbed me. It wasn't some polished studio interview, with prepared talking points. It was literally a fly-on-the-wall recording of two analysts, Eric and Daniela, just driving in a car.
Which is a great setting for this kind of topic. They were driving back from the Vancouver Resource Investment Conference, or VRIC. And for context, this isn't just a small local meetup. This is basically the Super Bowl of natural resource investing. You have the biggest names in mining, economics, precious metals, all in one place.
And because they were fresh off the conference floor, the conversation was so raw, they were just processing what they'd seen and what they saw. Well, it really sounded like a wake-up call. So our mission for this deep dive is to try to decode these mixed signals we're seeing. We're going to look at why regular people are selling gold right now while central banks are buying it hand over fist. We're going to get into some really counterintuitive advice about debt, specifically why paying off your mortgage might actually be a mistake.
Which is a controversial stance, to say the very least.
Oh, huge. And then we're going to look at the math behind the reset. And I have to warn you, the numbers we're going to cover, specifically about how fast this financial shift is happening, they are genuinely unnerving.
They are. It really ties into that concept of slowly, then suddenly.
Right.
But before we get to the math, we really have to understand the mood, the vibe.
Let's start there. The vibe at VRIC. So Danielle and Eric mentioned there were 8,000 people there. That's a massive crowd.
Mm.
But they said the energy was just different this year. How did they characterize it?
They noticed a split in the demographic, a real split. On one side, you had what they called the newly awake. These are people who are realizing for the first time that, geopolitical instability and the weakness of the dollar, these are active threats to their livelihood. They're scrambling a bit. They've realized that keeping their money in a savings account is actually losing them purchasing power.
It's that moment of panic where you realize the boat is leaking.
Exactly. But then you have the second group, the vindicated. These are the long-term preparers, the people who've been predicting this economic turbulence for years, maybe decades. There wasn't panic with them. There was this sort of grim sense of satisfaction, like, we told you this was coming, and now the data finally proves it.
But no matter which group they were in, Eric and Daniela said there was one core theme that united everybody. It wasn't just about inflation rates or mining stocks. They said the consensus on the floor was trust is collapsing. Now, that sounds like a great headline, but what does it actually mean in the financial context?
And this is such a crucial distinction. When we say trust is collapsing, we aren't just talking about not liking politicians. In finance, trust is all about counterparty risk. Think about a dollar bill. What is it, really? It's a promissory note. It's a liability of the Federal Reserve. For that dollar to have any value, you have to trust the issuer to manage their debts responsibly and not, debase the currency to zero.
So every time I hold a dollar, I'm basically making a bet. I'm placing my trust in the government.
Precisely. You are trusting a counterparty. Now compare that to gold. If you hold a gold coin in your hand, who do you have to trust for it to have value?
Nobody, I guess. It's just gold.
Exactly. It has no counterparty risk. It doesn't rely on a chairman or a president or a CEO. So when the source says trust is collapsing, they mean capital is fleeing from assets that require trust, like bonds and fiat currency, and it's moving into assets that require no trust, like gold.
Okay, that makes perfect sense. But here's where I get confused. If capital is fleeing to safety, why did Daniela say that large wholesalers are weeks behind on liquidations? That means regular people, retail investors, are selling their gold. They see the price hit a record high and they think, time to cash out.
This is the big disconnect, and it's the classic tragedy of a wealth transfer. You have central banks, the quote-unquote smart money, buying over 1,000 tons of gold a year, stacking it in their vaults. Meanwhile, the retail investor looks at the nominal price, the number of dollars, and thinks, wow, I made a profit.
They just see the number go up and they want to lock in the win.
But they are measuring the win in the wrong unit. If you sell your hard asset for paper currency just because the paper price went up, you're moving from a store of value back into the very thing that is losing value. You're trading a shield for a melting ice cube.
So the central banks are getting rid of the paper to get the metal, and regular folks are getting rid of the metal to get the paper.
And historically, the wealth moves from the latter to the former every single time.
This leads perfectly to the analogy they use in the car. I thought this was just brilliant because it simplifies the psychology so well. They compared investing in gold to losing weight.
It's a fantastic way to visualize the difference between price and trend.
Okay, so Eric says, imagine you want to lose 30 pounds. You know the formula, right? You need a caloric deficit. If you maintain that deficit, you will lose weight over time. The physics demand it. But if you step on the scale every single morning, what happens?
You drive yourself crazy. Some days you're up a pound because of water retention. Some days you're down 2. It fluctuates wildly. If you react to every single daily number, you'll quit the diet in a week.
So in this analogy, the caloric deficit, that's the fundamental weakness of the dollar.
Right. The government is printing money. The debt is compounding. That is the caloric deficit for the currency. It is guaranteed to lose weight, to lose purchasing power over time. Gold prices will spike up and down. Sure, that's your daily scale reading. But the long-term trajectory is up because the dollar is fundamentally dying.
So the advice is, stop looking at the scale every single day. Zoom out. If you understand the macroeconomics of it, the daily price of gold is just irrelevant noise. You hold it for the reset, not to trade the Tuesday afternoon dip. Zoom out. Easier said than done when you see a big number on the screen. Which brings us to the part of the conversation that I really struggled with. I want to challenge this because it just goes against everything I was ever taught. The debt paradox.
I had a feeling you'd want to dig into this one.
Okay, so Daniela tells this story about a family member. They've been stacking gold, doing everything right. Then gold prices hit a high, and this family member says, I'm going to sell my stack to pay off my mortgage. Now, to me, that sounds like the American dream. Get out of debt. Own your home free and clear. But Eric called it a dumb decision.
It sounds harsh, I know, but he's looking at it purely through the lens of a currency collapse.
But come on, how can becoming debt-free be dumb? Explain the mechanics here, because my grandfather would be rolling in his grave.
Okay, let's break it down. It all comes down to understanding who inflation actually benefits. We typically think inflation is bad for everyone, but it's not. Inflation is actually a tool, and it's a tool for the debtor.
How so?
Okay, imagine you owe the bank $100,000. It's a fixed number. Now, imagine hyperinflation hits. A loaf of bread costs $100. But wages usually rise during inflation too, even if they lag a bit. If money becomes worthless, that $100,000 debt becomes easier and easier to pay off in nominal terms. You're paying back the bank with dollars that have a fraction of the value of the dollars you originally borrowed.
So you're paying back the loan with monopoly money, essentially.
Exactly. The government has massive debt. The only way they can manage that debt is to devalue the currency. They need inflation. It's a policy choice. So if you have a fixed-rate mortgage, you are aligned with the government. You are shorting the dollar. As they destroy the currency, they are destroying the real value of your mortgage liability for you.
Okay, I think I'm seeing the logic. If I sell my gold, which adjusts up for inflation, to pay off a debt that inflation is naturally erasing, I'm doing it completely backwards.
You're swapping an appreciating asset for a depreciating liability. You're doing the bank a favor. You're handing over real wealth to settle a paper debt that is shrinking in real terms every single day.
But hang on, there has to be a catch here. This sounds really dangerous. What if I lose my job? The bank doesn't care about my inflation strategy if I can't make the monthly payment.
And that is the massive caveat that we have to state clearly. Yes, this strategy only works if you have the cash flow to service the debt. If you are drowning in monthly payments and you're at risk of foreclosure, then of course pay off the debt to survive. Cash flow is king. But if your income is stable and you can make the payments, mathematically you are better off holding the gold.
So it's a game of solvency. If you can stay solvent, let inflation eat your mortgage. If you can't, well, then you have to do what you have to do.
Precisely. It's not one size fits all, but for the person in Daniela's story, who presumably could make the payments, selling the insurance policy, the gold to pay off the cheap debt was a strategic error. And sadly, she mentioned that person sold, and since then, gold has gone up even more.
Ouch. That brings us to the question of value. Because people look at gold at, I don't know, $2,500 or $3,000 an ounce, and they think, I missed the boat. It's too expensive.
And the consensus from the VRAC conference was a resounding no. It is not too late. In fact, Eric laid out a specific calculation to prove that we are nowhere near the top. He called it the fair value calculation.
How do they calculate fair value? Is this just like guessing?
No, it's based on a very specific scenario, the reset. The premise is that if the fiat system loses all trust, we have to go back to a system where currency is backed by collateral. So to find the true price, you take the total world debt and you divide it by the total ounces of gold mined.
So you're basically asking, if we had to cover all this debt with all the gold, what would 1 ounce need to be worth?
Exactly. If you tried to back today's massive debt pile with gold at $2,000 an ounce, the math just breaks. There isn't enough gold. So the price has to re-rate. It has to.
Okay, so world debt divided by gold ounces, what's the number?
According to their calculation, the fundamental value is approximately $16,000 per ounce.
$16,000.
Yeah.
And we're currently sitting at, what, $2,500, $2,600?
Somewhere in that range, yeah. So when people think gold is expensive right now, they aren't looking at the fundamentals. Eric pointed out that gold would need a 300% to 500% rise just to hit its fundamental value against the current debt.
But let's just pause on that math for a second. A 300% rise isn't just a bull market. That's a completely different world. If gold goes to $16,000, what does the rest of the economy even look like?
That's the scary part. We aren't just talking about investment gains here. In a world where gold is $16,000, a loaf of bread is probably $20. Your savings account has lost massive purchasing power. So while the upside for gold holders is huge, the reality that comes with it is actually pretty somber. It implies a total failure of the currency.
Which is why the psychological window is closing. They talked about how hard it is to buy when the numbers get that big.
It's sticker shock. Buying an ounce at $2,000 feels okay. Buying that same ounce at $5,000. People hesitate. They think, I'm getting less gold for my money. But if the destination is $16,000, then $5,000 is still a bargain. The mental barrier is what stops people.
And this leads us to the most terrifying part of the whole deep dive for me. The velocity. The Weimar Germany comparison. We always hear about hyperinflation as this, historical thing, people pushing wheelbarrows full of cash. But we never talk about the speed.
And that is the critical data point, the slowly then suddenly dynamic. They broke down the timeline of how long it took for gold to move in $1,000 increments against the dollar.
I have the numbers here, and I want to walk through this slowly because when I first read this, I had to double check it. So to go from $35 an ounce to $1,000 an ounce, that took 36.5 years.
Right. Nearly 4 decades. That's a slow, gradual erosion of the dollar. Most people don't even notice it happening.
Okay. Then, to go from $1,000 to $2,000, that took 12.4 years.
So the pace tripled. We're seeing the compounding effect of the debt.
Then $2,000 to $3,000, 4.6 years.
You see the trend. It's exponential.
But here is where it just snaps. $3,000 to $4,000. The data suggests this takes 0.6 years. That's just over 6 months.
Think about that. What took 36 years at the beginning of the cycle now happens in 6 months.
And 4,000 to 5,000.
Yeah.
0.3 years. That's like 4 months.
This is the hockey stick graph. The currency devaluation accelerates exponentially. The system moves slowly for decades, and then it collapses all at once.
Honestly, that's frightening. Because it means we don't have time to react.
That's the danger of waiting to see what happens.
Right.
If you're waiting for a dip or you're waiting for confirmation that the economy is crashing, you might miss the move entirely. When the reset accelerates, the price just runs away from you. You wake up one morning and gold is up $500. You wait a week, it's up another $1,000.
They mentioned that at a certain point, it doesn't even matter if you have the cash. You might not be able to find the physical metal.
Eric made a very stark point about the Weimar scenario. In the end, gold was trading for trillions of marks. But nobody was selling gold for marks. If you didn't have it, you couldn't get it. The point isn't the number of dollars. The point is that you are holding the only thing that retains value while the paper burns.
It really just brings it all back to that weight loss analogy, doesn't it? The daily price is irrelevant. The trend is acceleration.
And we have to remember, the people at that conference, the vindicated ones, they aren't there to get rich quick. They're there because they want to ensure their labor, their savings, and their legacy aren't wiped out. They are just getting out of the way of the avalanche.
So what's the actionable takeaway here for the listener who's driving to work right now, hearing this and thinking, great, the economy is doomed. What do I do?
I think the first step is a mental shift. You have to stop measuring your wealth in dollars. If your house went up in value but you can buy less with the proceeds, you are not richer. You need to look at your portfolio and ask, how much of this relies on the dollar staying strong?
Reevaluate that counterparty risk.
Exactly. And practically, Danielle and Eric were kind of joking, but they were serious too. Don't sell your insurance policy to buy a new kitchen.
The wealth effect.
Right. When asset prices rise, people feel rich. They think, oh, my gold is up, I can afford that remodel. No, your gold isn't up, your money is down. Do not liquidate hard assets for consumer goods during the early stages of a currency reset. You will look back at that kitchen renovation as the most expensive decision of your life.
It reminds me of the guy who bought 2 pizzas for 10,000 Bitcoin way back in the day.
Precisely. Don't be the pizza guy of the gold rush.
So, to recap, trust is collapsing, which means smart money is leaving the dollar. We have a debt paradox, where keeping your fixed-rate mortgage might actually be the smartest play, provided you have the cash flow. And we have an acceleration of price that is moving from decades to months.
It's a lot to process, but that fundamental value suggests we are nowhere near the top. We're just leaving the station.
I want to leave everyone with a final thought on that velocity. We always think we have time. We think we can wait for the next paycheck or the next bonus or for the market to calm down. But looking at that timeline, 36 years shrinking to 0.3 years. Time is the one asset we are all running out of.
It raises the question, if the reset is accelerating, are you moving fast enough to keep up?
A provocative question to end on. Eric and Daniela joked about doing a gold rush happy hour next time instead of just the car ride. Frankly, after looking at those acceleration charts, I think I might need a drink too.
I think a lot of economists would probably join you at the bar for that one.
Thanks for listening to The Deep Dive. Keep your eyes on the big picture, zoom out, and we'll catch you next time.